All right, good afternoon, everyone. Okay. All right. Can you guys hear me? Good afternoon.
I can hear you. Good afternoon.
Okay. Hi, how are you, Rowan? How are you, Cedric? Matthews, are you there, Matthews?
Yeah, I'm here.
Okay, good afternoon. Okay, so well, we are getting more people, right? We're getting more people. We just 4 o'clock is the time we're starting. Uh, Now, if you, so there are 6 people. So if you are in the collaborate session, did you sign into today's forum? Right. Okay. Looks like you are, right. 4 of you at least, right? 4 of you are there. If you're not here, please uh, don't forget to sign in. That's the first thing to do. Okay. All right. And please remember, um, the class is for 1 hour on Wednesday and 2 hours on Mondays. So on Mondays, I'm more lenient on Monday uh, about your attendance. In other words, the cutoff line, the cutoff time for present and late, right? Cutoff time for present is 20 minutes past the hour in 2 hour session. So on Monday, even if you sign in, I mean, even if your timestamp here is like 3:19, you are considered 3:20. You're considered present. Okay, present for the whole time. Um, but if your timestamp is past 3:20, then that will be marked as late, right? But on Wednesday, because we have 1 hour, right? If your timestamp is after 10 minutes, then that will be late. Okay, so don't forget to sign in, right? That's the first thing to do. You need to validate your attendance, right? You don't want to get right. You attended but forgot to log in, and then that will be unfortunately you'll be marked late or absent, right? So don't forget to do that. Alrighty, so I'm seeing 10 people. Okay, let's go back to what we were talking about on Monday, right? So uh, basically, we are done, pretty much done with everything. The only thing is, we want to make a connection now. We want to make a connection between the income statement and the balance sheet. And to do that, I told you we need 2 balance sheets, right? Balance sheet at time 0 and the balance sheet at time 1. Okay. So maybe I should, move. If I can move, yeah, I should move this. Okay, so I think I can move that. Okay, and I cannot move. Okay, looks like if I cannot move it, I can at least elongate it. Okay.
Professor,
Yeah.
when are we gonna start having in-person classes again? Do you know yet or
Um,
none?
well, I'll let you know by the end of this week because I just took the PCR test. So the test results will come back within 24 to 36 hours. So I will know if I'm most likely I will the test will come back negative. Um, and once I'm negative, they will reinstate my access to the building. So I will know within 36 hours, and then I will post it in the. But until I get to the building, I wouldn't know. I don't know if my card key works or not. But um, either as soon as the test comes back, but I will first have to test if the card key works, and if the key doesn't work, I will have to I'll have to sort it out with the public safety to reactivate my card key. So by next week, most likely we will be able to uh, by next week or the week after next. We will be back in campus.
All right, so you'll be able to let us know before the Monday class, right?
Yeah, sure, right.
All right.
So first, if the test comes back, of course, and as long as it comes back negative, um, then I will get my cleared for back. I will be cleared for entry into the building again. I mean that's cleared for only. But it may be a separate issue to actually reactivate my card key. So if my card key is not automatically uh, reactivated, then I'll have to that's really a cumbersome process, but I will have to go to the public safety and um, get it reactivated. So yeah, at most by at the latest by the week after the next. Okay. All righty. So where was I? Okay. So uh, as I said, two balance sheets and one income statement, right? Because the balance sheet, I have to move these things again. Uh, okay. So think about it. What the balance sheet is showing you is how much each line item um, has changed over 1 year period. It can be 1 year or 1 quarter, but let's say let's assume we are looking at the change over a year. Okay, so this I cannot. So we have balance sheet at time 0, which is the beginning of the year, the balance sheet at time 1 at the end of the year, and obviously during in current assets, between current assets at time 1, non-current assets at time 1, change has happened over 1 year, right? There will be a change, right? And then there will be current assets at time 1 will be different from current assets at time 0. Non-current assets at time 1 will be different from non-current assets at time 0. Again, non-current assets, non-current assets consist of equity and debt, right? And I'm only remember, asset side, basically assets consist of equity and debt. But I would like to look at equity primarily. Obviously, equity will change. So at time 0, the company, time 0 is, basically the beginning of this company. At the beginning, and of course, the beginning here, it's regardless of, regardless of IPO. In other words, it doesn't mean the beginning of the company doesn't have to be the point where the company goes public. Okay, the beginning of the company is literally when the company was first, founded, and at that time, let's say the company raised the $60 million in equity, which is, of course, for a startup, this is unthinkable, this is unrealistic. But we're just assuming, even at time 0, this company was able to raise $60 million. They were able to fund it by equity. So that means, they sold shares, they sold stocks, right? Of course, selling not in the stock exchange, right? Because this is before going public, right? But then how can they sell stocks? I mean, even if you're not listed in the stock exchange, then it's private. It can be privately traded, privately, right? So if venture capital, let's say venture capital approached, they met a venture capital, or venture capital approached them and offered to invest $60 million, which is unrealistic as well. I mean, if you're just a startup with no track record, no venture capital will, you're just a big question mark, and then no venture capital will invest like $60 million, maybe $6 million, maybe, but that's even maximum. I mean, to a completely startup, even investing $6 million is just too much risk. But just we are doing just a hypothetical example. So let's assume that they were able to sell 1 million shares to the venture capital. I mean, when venture capital invests, they demand shares, right? They demand stocks in exchange. So they issued 1 million shares and gave it to the venture capital in return for $60 million investment. So the venture capital will have 1 million shares. Of course, in reality, it will be more than a little more than 1 million shares, because the founder, like Michael Dell or Bill Gates or Steve Jobs, they need to have some stake in the company. But their investment is not money capital. Their investment is their technological savvy, and their basically their intellectual property. And for that, that's non-tangible. That's non-tangible capital, right? That's non-tangible asset. So anyway, and they have operated for 1 year, right? And after operating for 1 year, that result, the result of operating for 1 year will be reflected in the income statement. Isn't that right? The income statement is no. So the income statement at time 1, right? Income statement, it has to be time 1 because at time 0 there's no income, right? By operating for 1 year, at the end of year 1, so at time 1 you will have income statement, right? You cannot have income statement in time 0. So this is why you need 2 balance sheets and 1 income statement. And in the income statement you will have, we all know, you start with revenue, right, which is income, right, and then subtract CGS, subtract operating expenses. Right, and then you arrive at operating. You arrive at EBIT, right? Earnings before interest and taxes, and then subtract interest, right? And then we know. So just to make it simple, I will. Okay, subtract interest and subtract taxes, and we arrive at EAT, right, which is net profit. EAT at time 1, this is, right? You cannot have net profit at time 0, right? You cannot have EAT at time 0, right? Because there's nothing at time 0. There's nothing. But now let's think about it. I said last time, this 60 million is paid in capital, right? Paid in capital. In other words, equity or debt, right? If this company has, 60 million, remember we assumed, $60 million is equity, 40 million is debt, right? $40 million. $40 million, right? But these are called paid in capital because it's really paid in, right? The venture capital paid in 60 million. The lender or the creditor or the bondholder, they paid in 40 million for, they paid in 40. That's, paid in capital. Now, after operating for 1 year, then you will have, you end up with, earnings after taxes at time 1. Now, EAT, so that's net profit, and net profit belongs to whom? Who does that belong to? Think about it. Who does that belong to? Anyone? We all know who this belongs to.
Would be the equity holders, for the owners.
Yeah, to the equity holders. Yeah. Who said that? Who said that? To the equity holders.
Rowan.
Roland. Yeah, Roland. You're getting, 0.5. Of course, it's profit. Profit belongs to the shareholders, the equity holders, right? Profit belongs to the equity holders or the shareholders. I shouldn't use that. Was the red pen. Somehow it always gives this arrow, right? it belongs to the equity holders. Because, so that means if it belongs to the equity holders, of course, because equity holders are the owners of the company, so profit belongs to the equity holders, the stockholders, right? And then, so the nature of the capital, I mean, in terms of the it's called capital component, in terms of capital component, right? This is what? I mean, what is this? When we say capital component, there are only two. There are only two types of capital components. What are they? Anyone? Think about it. Where did the capital come from? I mean, this company's total assets was $100 million, right? $100 million. 60 million came from the equity holders. 60 million is that's why equity. 40 million came from the debt. 40 million is debt. That means it came from the creditors or lenders, right? Or bondholders, right? So that means, there are only two sources of capital. Isn't that right? Only two sources of capital. And what is that?
Cash would be one.
No.
No. Okay, so I'm thinking of something different now.
Cash. Where did the cash come from? I mean, from the day one. From the day one, did the cash just exist there from the time zero? From time zero? Huh?
No, I was thinking cash was from the 60 million from the venture capitalists. That's what I was thinking of. Cash.
Yeah. Look, 60 million which came from the venture capital. That's cash, of course, right? But 40 million that came from the bank. Isn't that cash as well? Isn't it right?
Yeah, I was gonna say bonds, but yeah, it is cash.
Yeah,
Bonds.
originally, so we go back to, remember originally, 100 million came from either equity or debt, right? And so that's why the this side, equity and debt, this side, what's going on? This side is the source of capital, where the capital came from. And then this side is how the capital is held, right? In what form the capital is, in what form is the capital held? The capital is held in what form? So basically, when it came from the source, it was in the form of cash, of course, right? It's money capital, right? In the form of money capital. It came $100 million. That was originally all cash. And then when it was poured into this company, then the company turned it into fixed assets, like plant and equipment, land and building, and some of it, $90 million of 90 million turned into fixed assets, right? 90 million, in other words, the original, right? From the original 100 million, 90 million turned into fixed assets, but remaining 10 million is held in the form of liquid assets, right? So this is, the use, how it was used, and this is where it came from, right? Where that 100 million came from. That's why I've been saying it's the source of the capital. So then the source of capital, there are only two sources of capital. Isn't that right? In other words, there are only two types of capital, right? Two types of capital that, capital source that, this 100 million come from. So what are those two? You already know the answer.
You said debt and equity, right?
Debt and equity, yes, of course, debt and equity, right? Debt and equity only. There are only two capital components, right? Only two capital components, debt and equity. So but we know this belongs to the EAT, belongs to the equity holders. So if we identify or define the nature of capital, this must be what? If we define the nature of this as, capital component, what is it? Why you guys are stuck there? Isn't it? This is equity because it belongs to the equity holders. It is equity. You understand?
Yeah, that makes sense.
Does it belong to the debt holders? No, it doesn't belong to the debt holders. It doesn't go to the bank. It belongs to the equity holders. So the nature of capital, right? In terms of nature of capital, it is equity, right? So think about it. So this is this is not paid in equity, not paid in capital, but equity generated from. Oh, why is it? Because it is red. It's got a tail. I mean, it's got arrowhead all the time. This is new. I don't know. It automatically what's this? Whiteboard automatically updated while I was sleeping, and then now it is. It doesn't give me the pencils with different colors. It's just only 3 pens, and one of them, red, is always, it has arrowhead. So, it's crazy. So this is, equity capital or equity internally generated or generated by equity generated by operating activity. Right? Is equity generated by operating activity. Or you can consider that internally as internally generated equity, right? Rather than equity injected from outside, right? Rather than equity paid in from by venture capital or outsiders. This is equity purely generated by the company's own activities. Isn't that right? So it's still equity. So in other words, and if this is, let's say 10 million, let's say this is 10 million. So if this is 10 million, then at time one, by the end of, what's going on? What's happening? Yeah. So here, so this will be reflected in, so at the end of year one, this will be reflected also where? Well, is it going to be reflected? It should be reflected here as well in the balance sheet. In other words, equity at time zero was 60 million, right? But then by the end of year one, the equity at time one will have to be exactly equity at time zero plus EAT at time one. Isn't that right? You understand? Are you following? No? I don't know if I can go on like this. Huh?
Yes, Professor. I'm following.
Yeah, thank you for, thank you for that affirmation. Now, think about it. At the end of year one, the equity at time one will have to reflect exactly that change in equity, right? And the change in equity comes from the operating activity. It comes from right? It comes from this, right? So then think about it. Number of shares at the end of year one is still what? 1 million, right? But so equity at time one is what? In dollars, what is equity at time one in dollars?
60.
No, that was 60 million. It was equity at time zero. I'm talking about equity at time one. What is the come on, guys. What is equity at time zero is 60 million. What is EAT at time one? Is this difficult?
So there'd be $1, right? Or 10? Yeah, $1. No, $10. My bad. 10.
$10? What is $10?
Our EAT is 10 million, right?
10 million. EAT at time one is 10 million. So what should be the equity at time one?
10 million.
Oh no, why is it 10 million?
20 million.
Why is it 20 million? You guys are just, I don't know what you guys are looking at. Are you looking at this? Can you read? Can anyone read what the definition of equity at time one? Can anyone read the definition of equity at time one? What did I write there?
It says 10 million, right?
70 million?
Yeah, 70 million. Who was that? Daniela, right?
Yeah.
That makes sense.
Daniela. Okay, Daniela. Yeah, you're getting 1 point. Listen, you guys, I don't know what you guys are thinking, but only Daniela got it right, and the other guys can't read this. EQ1, equity at time one, is equal to EQ0 plus EAT1. What was EQ0? 60 million. EAT1, 10 million. Then equity at time one should be 70 million. Isn't it right? That's why I said, I made a distinction. Paid in capital, and that's why I made a distinction between paid in capital and internally generated equity, right? Paid in equity versus internally generated equity. So equity, then think about it. There are still 1 million shares outstanding. Still 1 million shares outstanding. So then what should be the book value per share?
70.
$70. Right, $70. And who says $70? Who says $70? Wasn't it Daniela? Right? I can't hear you. Was it so? Some okay. Okay, Daniela, I believe you raised your hand, but there was no way I could see that. That was you, right, Daniela? You said 70, right?
Yes.
there's there is a lot of I guess howling or delay. So yeah, then you divide it by 1 million shares, right? Number of shares outstanding 1 million. So then book value per share at time 1 should be exactly $70. Okay. Again, it's book value and the market price, just like last time I told you, market price can be different, right? Again, the reason there's a difference between the book value and the market price is because there's a time lag, time delay, right? In other words, when this data is released, then the market price will approach the book value, right? When the data is, but after the data is, after some time, there is no concrete data. After some time, the data that was released becomes the past data. It just becomes the past. And then the market is looking for some clues, and the clues are not based on the fundamentals, but a lot of noise. And market participants are swayed by noise. So there is there is a lot of misinformation or noise. Noise means just misinformation, a lot of rumors and things like that. Think about it. Why is the market price fluctuating like crazy? It's because the market participants are betting on those rumors, the noise, right? If the market is acting only based on the the fundamentals, then there will be no price change. I mean, the price will change only at the end of each quarter, and between the quarters, then there will be no movement in price. Why? Because what did I tell you? The operating cycle, right? The companies, all the companies that are traded in the stock market, right? All the companies traded in the stock market are basically, they have an obligation. They have an obligation to update their financial statements quarterly, right? And I've been telling you this over and over. They release the data. So think about it. You don't know how much the company earned until they release the data. And they release the data only after the quarter is over. I've been telling you, what quarter is the basic operating cycle, right? They don't update this data until the end of the quarter. And the quarter must end first, right? You cannot have the data for the first quarter. You cannot have the first quarter data at the end of March. You can't, because first quarter must end first. Isn't that right? The first quarter must end first. And once the first quarter is over, then they compile the data. And then after they compile the data, then they can make these earnings calculation, right? EAT. They can find EAT, and then they can release the data. So that will be that's called earnings report. and the earnings report comes out usually in the first month of the following quarter. Okay, everyone heard me? So usually the first month is called earnings season. What does that mean? The earnings report comes out in the first month of each quarter, but that earnings report is of the previous quarter. Common sense tells you, think about it, the common sense tells you that you cannot have the data, that the current quarter's data during the current quarter. Isn't that right? The current quarter must end first to have the data. And so if the first quarter is over, then it takes time to compile the data. So they release the data in the first month of the second quarter. It's just like that. And once the earnings report comes out, right, then the market price responds to that. Market price reacts to that, book value, because book value is based. So think about it. This is like one quarter ago. Of course, I said, this was 1 year between, time 0 and time 1. But if we just assume that this is, a quarterly statement, at the beginning of the quarter, so that was as of the last quarter, the price was $60. Beginning of this quarter is the same thing as the end of the last quarter, right? The book value was $60. And then between time 0 and time 1, the price moved a lot, right? Because between time 0 and time 1, there is no solid data. There is no updated data. The data gets updated only at the end of the quarter. So there is a lot of fluctuation in the price, market price. Makes sense? And during all this time, the only solid book value based on the data was this. But then think about it. This price is already based on the past data, right? In other words, this is based on, December 31st, 21, right? Now this will be the data based on March 31st, 22. So think about it. In the meantime, no concrete data, no solid data. So the price will fluctuate a lot, right? The market will, market has no idea what is the, market has no clue. Market has no clue, what is the solid data. The only solid data they have is as of end of last quarter, right? Makes sense. So the price drifts away from the past, because that was past already. So until the new solid data comes out, the price drifts, right? That's just the nature of the market. Market is fickle. Market is, irrational. Market is irrational in the meantime. During this period, market is irrational because they only, with no solid data, they only trade on noise, based on the noise, right? There's no reason for the market to go down like this. I mean, the market has been going down. NASDAQ has lost almost like 18%, from its highest point, last highest point. No reason for that. The economy, I mean, other than other than the concern for the interest rate to go up, right? And today, Federal Reserve announced, 0.25% interest rate hike. But that was already expected. That was already expected from even, 2 quarters ago. That was already expected. Nothing new. It has already been priced in. It's not a surprise. It's not a shock. The only thing is, obviously, inflation is a concern, but then it's not like the economy is weak. Economy is not weak. The economy is, as I said, there are more job openings than the job applicants. And today in New York, I don't know if it was Wall Street Journal or New York Times, there was an article about, $100 starting salary of $100,000, 100,000 for just a college graduate. Of course, you have to be like from MIT or Harvard, but in the financial financial sector, $100,000 startup salary. Why? I mean, a couple of years ago, even if you're from one of the Ivy Leagues, with just bachelor's degree, it wasn't 100,000. It was only like like 85,000, but that was even very high for a bachelor's, just for, someone with a bachelor's, just out of college. Now, today, the salary, the beginning salary, the starting salary is $100,000 for people in the financial sector, for graduates, college graduates from Ivy League. And that that means even if you're not from Ivy League, your salary would still be somewhere near 90,000 or something like that at least. Why? Because there are about 1 million job openings still unfilled. If the economy is weak, if the economy is bad, will there be that such huge number of unfilled job openings? In a bad economy, you can't get a job. You can't find a job because there are no job openings. This is the clear evidence that the economy is very strong. The only, of course, because of high wages, it's also part of the reason that the inflation is going up. But this is demand pull inflation. In other words, it's the inflation. Demand pull inflation is the inflation caused by strong demand. Now, of course, most of the inflation is due to a lot of money supply that was poured into the economy during the pandemic, but it didn't but it doesn't mean that it's simply just increased money supply. I mean, economy didn't lag. If the economy lagged, but there was just a lot of money supply, that's very bad inflation. But the economy didn't lag. There is the supply chain shortage, supply chain disruption. And what does that mean? That means you can't, just like people, job openings that cannot be filled. The production needs these parts. I mean, that means demand for the goods and services, but the parts are not coming in, right? Supply chain disruption. That's one reason and so obviously, so the price of, input cost goes up because, because of supply chain disruption, right? We have shortage of, parts and raw materials, right? So think about it. All right, we're already out of time. I want, just think about it. So EAT is 10 million, right? But then think about it. How many shares are outstanding? Because it belongs, 10 million belongs to equity holders, and there are how many shares are outstanding? We all know 1 million shares. 1 million shares outstanding. So then per share, right? How much is it per share? How much is the earnings per share? So it will give us what earnings per share is. What's going to be the earnings per share? What's the earnings per share? Anyone? If this is EAT, that belongs to the shareholders. There are 1 million shares outstanding.
It'd be
Then if you
$10,
divide
right?
it, $10. Yes. Who was this?
Rowan.
Roland?
Yeah, Rowan.
Roland. Kessler. I'm sorry, Roland Kessler. What was your last name?
Rowan Clausen. Yeah.
Roland Clausen. Okay, Roland. Yeah, you're getting 0.5. Yeah, $10. That's what's earnings per share. And if you think now, we bring the picture together. We bring everything together. We put everything together. So think about it. What is book value per share at time 1? Book value per share at time 1 is exactly book value per share at time 1 is exactly book value per share at time 0 plus earnings per share at time 1, right? That's book value per share at time 1. Okay. There's more to talk. There's more to talk about. A lot more to talk about earnings per share and book value per share. But that's all the time we have. So I'll have to call it a day. If you any further questions, you can ask in the next class. But that's it for today. Have a great afternoon, everyone. I will see you guys next Monday. Don't forget the quiz 1 is on this weekend. Okay? All right? All right.
Thank you, Professor.
Thank you.
All right. You're welcome. You're welcome. Have a great afternoon, and I will sign out. Stop recording.